All right, good morning, everybody. We got a busy day, a lot on the agenda. All right, so the dollar is still holding up, a little bit. Crude still coming off. It's interesting to note what was coming through on the tape for the energy markets. They're saying it was a crowded trade and that everybody was locking in profits, and that's why it took that tumble. Okay, I mean, then isn't that why things go down anyways? People are taking profits. Anyways, just found that slightly amusing. So as usual, we go to FX Street for that, get a little bit of a perspective on the dollar from time to time. As I've mentioned before more than once, when it comes to the dollar, we have to have something behind the candles that we see. We got to have an understanding of what is driving that move in the dollar, because there are times where a bullish dollar is a global risk on sentiment. And then there are other times where a bullish dollar is a sign of global fear, where it uh, couples with the VIX and it begins to mimic the VIX. What is up with Bloomberg here? Bloomberg has a publication every morning called Five Things You Need to Know. It's a really good free publication when their site works. Yeah, enough of that. Let you guys go over there on your own and go to Bloomberg and sign up for Five Things You Need to Know. You'll get a free email from them every morning. So today, 8:15, 8:30, 8:55, and 11 o'clock. It kind of ties right on in there with the dollar and the bonds. The dollar opens at 8, the bonds open at 8:20. So we've got we got the 8 o'clock open, the 8:15 housing stats, and then the 8:20 bonds open, and then the 8:30 Empire State Manufacturing. So as you can imagine, that window of opportunity there in the morning between 8 and 10 is really just a very hazardous place to trade. One thing that I'm constantly focused on is ways to reduce my risk in trades. So I just don't trade between 8 and 10 unless I'm trading one of these economic events. I'm certainly not telling people to avoid trading in that area. I just don't, because it's a higher risk. Generally speaking, you need a bigger stop. The markets can go against you unless you're timing your trade against that report, and you're just very likely going to deal with a more catalyst in price than it's worth. Right, the juice ain't worth the squeeze. Newer traders seem to always make the mistake of thinking that the big move at the open is what it's all about. And those big moves aren't what pays the bills. All right. So for the ES, we did get a little rough last night. We dipped down below a major level. When we bring it out to the daily chart, the low is in. It's been in on the ES, right? They called that as the low a while back, but the rally out stumbled and failed, and we've just kind of slowly drifting back down towards these lows. So we had an angled line of support. We broke that last night. We're headed back down to retest these lows. I really don't think that it's a matter of if we will test them at this point. It's when will we test them at this point. There is a weekly expected move below that 4100, which is the critical level that we're talking about. The Nasdaq breached that level, that same low yesterday. There's a death cross on the S&P now. It's either predetermined or it's already happened. And historically, while the death cross is a bearish signal, generally speaking, Historically, every time that we've gotten one of those in the S&P, it has turned into a buying opportunity and was a bullish catalyst. Now we'll see, right? It all comes down to the Fed at this point. Been keeping track of the negotiations and the talks with Russia and the Ukraine. Talks keep breaking down. Um, but again, like I said yesterday, the market is going to get tired of that. It's going to get tired of the war, of responding or reacting to the war, and it will just move on. I know how callous that sounds, but if you think about, the U.S. has been in a war for 20 years, and after the first few months, you didn't hear about it very much anymore, right? You certainly weren't seeing it priced into the market. This isn't even our war, so you can imagine how quickly the market will move on from this situation. Until then, we still have to remain very, very cautious on these moves to the downside. I didn't run a 0 day yesterday, for an example, because the 0 day has a lot of risk. I just went ahead and traded this move in the futures just so I didn't have to worry about any kind of news from the Ukraine spiking the market to the upside and running me over, or spiking the market to the downside and running me over. So I didn't put on a 0 day yesterday. The 0 day for me is usually where I size up, go really big, and those hold a lot of risk. Yeah, so much less risk just trading the move in the futures. For today, we're back inside yesterday's range. So we're looking at an inside day. We are starting the FOMC meetings today. It's a 2-day event. We got a lot of economics earlier this morning and an additional auction at 11. And that's pretty much it. So if we can get past 11 o'clock, we're good to go. Um, we ought to know very, very clearly by 9:30 when the market opens how this economic news is going to affect us. It's going to start. Is it going to just be ignored, or it'll have a bullish or a bearish catalyst to it? So it won't be subtle. It won't be a surprise. We're still expecting a range-bound market until the FOMC announcement. So while we could break new lows, like we broke new lows yesterday and we broke new lows last night, no one's saying that we can't, wick down and get new lows or even get new highs if that's what we had, say, the last FOMC. But that it's very likely not going to really go anywhere, right? It does. Just like now, we're right back where we were yesterday. And yesterday, as we had come into the open, we were right back where we were the day before. So the market's just on pause. It's making moves, but not real significant ones. It's not a change in market sentiment. And we're not going to see that until the FOMC announcement. It doesn't even matter that the market already knows or thinks it knows what Powell's going to do. It's not the 25-point basis rate hike that is the uncertainty, right? It's what are they going to do with their balance sheet? And what is his forward guidance going to be on what will make them make decisions at the next meeting, right? So we're really going to be looking for what he says and how he says it and what he implies at that meeting. So until then, we're just running on the technicals. Yeah, we've got our low of the day in this Globex. We're re-challenging this Globex high. So should we get through the high, we'll focus on the RTH. Well, that's really too close. We'll skip the RTH or combine those two. And then that would put us pretty much into the Globex lows. You could also look at that as the RTH open. They're very close. And beyond that, the RTH high of yesterday. Now, speaking of the open, it kind of all ties in really close with that little gap that we had So I would mark this whole thing out as a zone. And I think when we go over and look at the volume profile, you'll kind of see why that fits. So it's the 4200 area. It's a critical level. We've got a lot of pricing in there, got a lot of volume nodes. This morning we did break an angular line of resistance. I think the one that I had marked off that we had broke through was the high of yesterday and the Globex of last night. We did break that. So right now we're testing against the high from Friday. If we connect those two pivot points, just shoot the line forward. There is a weekly pivot point up ahead, but it doesn't look like we're going to be getting anywhere near it at the moment. Take a look at that volume profile. So you can see we're outside of the box, but we are moving back towards the box, right? We always want to focus our attention on that. Are we moving towards the box or away from the box? Are we in the box already? Are we at the lows moving higher from it? Are we at the highs moving lower from it? We are right at a level of volume, kind of struggling to get back above that level. Uh, should this fail, and should we fail to get back above the Globex high of 4180, then it's very likely we're going to retest yesterday's low and then retest the Globex low. That's 4129 down there. Below the 4129, we've got a cog line. Not much more beyond that other than 4100, which is the low that they had when they called the low a few weeks back. It's very unlikely we're going to have that kind of sell off without some catalyst coming in. And at this point, the market already knows that these economic numbers that are going to come in today will not affect the FOMC decision that has basically already been decided, right? So the numbers coming in today will just be more fuel on the fire. It's very hard to imagine that any of that news today could put us into a bullish stance. So we're not going to have any expectation of that. We're nowhere near the daily moving averages, so we don't have to worry about anything like that over our head. So round numbers, 4200, 4100, Globex high, Globex low. There is an expectation of more range than anything else. If we do get a burn like we did yesterday, it was a really nice controlled move. Just want to continue to validate that move, just like we did Friday, just like we did yesterday. The way we've been validating that move is confirming it in all of the other tools that we can look at. We got the advancing issues, the declining issues. I rarely, honestly, ever use declining issues. Simple math. If you've got 100 names and 25 names are going up, what in the hell do you think the other 75 names are doing? Right? So it's on you. You want to look at advanced decline. You want to just look at it decline. You want to just look at advancing. I use advancing. So advancing issues in the S&P and advancing issues in the Nasdaq. We held below 50% in the S&P. We had a consistent, persistent move through those. Just really clear signals. Same thing in the Nasdaq. We got below 50%. Managed to get down around that 25%. Just a clear, consistent, persistent move to the downside. All this is asking is how many names are advancing. So if there's 100 names and 50 are advancing, then the others are not advancing. Simple enough. The index themselves continue to be off compared to their futures counterparts. I rarely ever see something like this, and so I'm still stuck on it. The S&P is not correlating as tightly with its ES counterpart as it should. The same thing with the index. It's not correlating with the NQ the way that it should. I don't know what to do about it. It's just something we definitely want to recognize and point out and say that this ain't right. Speaking of not right, yesterday we had stocks and bonds both moving in the same direction for long periods of time. That ain't right. That ain't what it's supposed to do. Another signal that we had yesterday that was very clear and very clean was the cumulative tick comparison. Each market has a cumulative tick. When we stack all those cumulative ticks into the same chart, we can compare them to each other. The S&P, the Nasdaq, the Russell, the NYSE. They were all moving in a consistent, persistent direction. We had a very clear, very clean tick. You can see how we maintained below the zero line for long periods of time with just very gentle moves above the zero line, continuing to confirm all day yesterday that there was no reversal coming, that you didn't have to try to catch a falling knife, that you didn't have to try to go long at any point yesterday. Everything was signaling very clear, very clean. And then looking at the FANG names, all summed up into one single indicator. We had that tight correlation yesterday where everything was just wound up really nice and neat, absorbing all of the news from the weekend. Clear break to the downside, and it never looked back. Every single tool that we have and everything that we look at yesterday said just keep running it to the downside. Bitcoin's off of its high this morning, and so is gold. The bonds did decouple from us finally a little bit. So that started to happen last night. Bloomberg was doing the Asian Open or before the Open, and there was a statement from, I think it was JP Morgan or Goldman Sachs, that basically said Asian tech stocks are uninvestable, and their market just started to absolutely crash. Before their market opened, they were down over 3%. And surprisingly enough, there wasn't contagion that bled over into our market. Really surprised about that. Kept waiting for it to happen last night. Had a little bit of a sell off into the Asian Open. And I mean, compared to how bad they burned yesterday, this is nothing. Really surprised about that. But we do want to continue to watch and make sure that the stocks and bonds stay decoupled from each other, right? Yesterday, everything was moving in the same direction, stocks and bonds. And there are times in history where we've seen this happen before. It's very unusual, right? So we want to recognize when there is unusual activity going on so that we can maybe dial back our positioning, lock in a little bit of profits, just be prepared for, say, the close, right? When the bonds closed yesterday at 3 o'clock, I really expected a significant shift in market sentiment, and we really didn't get it, but at least I was prepared for it, right? That's kind of the idea behind it. When you have the dollar and the bonds close at 3 o'clock, that's very often why power hour becomes a change of sentiment, is because these two close and their weight or their impact within the market is gone. We didn't see it yesterday, but I was certainly ready for it. We also pulled back from that high. There was the expectation that we were going to hit $100 yesterday, and if we had, then there would have been and there still could be, a major impact of that, right? It's a psychological level, it's a critical level, but we didn't. We're pulling back off of it. So we're going to keep our eye on the dollar. We don't want to see the dollar start to pair up with the VIX. And last week, crude hit multi-decade levels and has been on the sell-off since then. And like I mentioned at the start of the briefing, um, JP Morgan, Bloomberg, all of them are saying that everybody was locking in profits, basically. So, you add that with Abu Dhabi bringing on more oil, and there's been talk of releasing more reserves, that we could see these prices begin to stabilize. Gold is still the hedge bet. So when we're going throughout the day, keep your eye on gold and Bitcoin. It's a little bit of those confirming indicators. And they haven't been coupling the same way with the bonds, the way that our market did yesterday. So they're providing that little bit of extra perspective. Depending on where we're opening, we could be opening back inside of yesterday's range. This will give us a chance for an inside day breakout during regular trading hours. That's a trade setup. We could get one to the upside. It's just really unlikely, guys, unless we get some news. We're not going to get that upside breakout. Bring it over to the NASDAQ. Mentioned that critical low where they kept saying the low is in and the low is in. Yeah, well, not anymore. We got a new one, right? We broke that critical low yesterday. Seen a lot of headlines saying that the Nasdaq has triggered some kind of technical that calls it a bear market that hasn't happened since 2020, most likely. Um, I don't know what technical they're using to call that, but I mean, at this point, if you hadn't already decided that we were in a bear market, then I don't know, what else you need. A written invitation, neon flashing lights, someone to take your hand and walk you over and point to it and say, this is what a down market looks like. But hey, somebody figured out and wrote a headline. So I'm glad they're finally on board. We're very close to the weekly expected move low. Line in the sand to keep your eye on. We had a really nice balance zone from last week, and that is most definitely broken. So we want to keep our eye on that level, see if we can maintain above it or not. And again, these often, very, very often provide contrarian setups, right? Just like that death cross that we were talking about in the S&P, while the death cross is very often a bearish signal, it's a buying signal historically in the S&P. Well, we just broke a major critical level in the Nasdaq, and at least one institution is seeing that as a buying opportunity. There's multiple headlines now saying that companies are performing buybacks right now at greater levels than they've seen since, and I don't remember how long the date was, but it's most definitely a buying opportunity for all of tech companies and any company that thinks that their current beat down stocks are on sale, right? So there's a problem with that, right? And the problem with that is, where do they get the money to buy the stock? Well, very often, most of them are borrowing that money. They borrow that money at really, really cheap interest rates, except interest rates aren't going to be so cheap no more, right? So the banks love it. They get to raise rates. Tech companies don't love it because now they've got to pay on the money that they borrowed at higher value than they normally would have, right? And tech really, really loves to borrow. It's their it's their crack, right? It's their cocaine. It's what they just love it. They're all over it. I've heard it called an addiction, but of tech, that they just can't help themselves. They go out and borrow and borrow and borrow. So, you really want to keep your eye on that. If they are going to continue to buy, and they would be, you can go in and look, bring up the live news on any of your companies. If they've already started mentioning buybacks, it'll be in here. You shouldn't have to go back too far. And, Thinkorswim doesn't really go too far back. It depends on how much news a particular product has. But if there's going to be any buybacks, this is where you would find it. If you have something like Bloomberg or Wall Street Journal, you can run search. Should be able to find something like that. Still not seeing any real redemptions coming in, which is good. Had someone ask this morning if this seems to have, are we calling the low yet? No, we are most definitely not calling the low yet. There was no signal yesterday at all that said that this is in any way exhausted or is tired or that we've hit an oversold, I hate that phrase, an oversold level. Every technical indicator we got says that we're oversold, but that doesn't mean that the selling is done, right? And certainly nothing is showing that it's slowing down. In fact, it's still very controlled. It's very robotic and methodical. There was a little bit of a pop in the VIX, but not very much, considering the absolute nasty lows that we're in the S&P and the Nasdaq. That VIX is doing nothing. A little bit of a move, and seriously, like that's a little move. That's nothing. So I don't know. Maybe the VVIX. This would be the oh, think of this as the implied volatility indicator for the VIX. Technically speaking, that's not what it is, but if you think about it and try to have a way of explaining to yourself what it is that you're looking at, then really think of this thing as a volatility indicator for the VIX, because you can't put implied volatility indicators on the VIX, right? You can put it on there, but it wouldn't make any sense. So if we don't have an implied volatility indicator, then we need some way to measure how volatile the VIX is right now. What's its rank? The VVIX can help you grasp that, be able to see it. And as you can see, looking at the volatility on the VIX right now, we're kind of low. We're above the extreme, sure, but we're nowhere near the highs. And if we look at it on a 1 year basis, which is how we generally calculate rank, think about how rank works. Very simple way is just to kind of eyeball it. 50%, 100%, 0. Where are we at? 50%. We've got a rank of 50 in the VIX. This is the VVIX, by the way, if you want to go in and look at that for yourself in more detail. So the VIX itself is not really volatile considering the levels that we're at. Keep your eye on that, because if it really starts to explode, it will be an early warning indicator that something is drastically wrong, right? And that, where's the fear? Where's the angst? Where's everybody capitulating and saying, finally, screw it, I can't take it anymore, I've had enough? We're still not seeing it. Another thing that stands out is the FANG names, and we continue to watch them constantly. Well, Apple is finally getting whacked on the global scale, right? And this is a big one. Bubbles don't break all at once, right? They don't pop all at once. So first it was small caps, then it was mid-sized caps, then it was large caps. Now they're going after mega caps. The exposure to global risk is the only thing apparently that was or is enough to start taking Apple down. When I seen the headlines on this yesterday, I completely shifted my entire market sentiment. So we need to see Apple hold this level, and stay within this weekly expected move. If it breaches this expected move, oh boy, I think it's going to be the beginning of the end right there, and we'll start to actually see the real fear coming into this market. Apple and Microsoft are the last two major holdouts, and you know, taking with that the idea that the fangs are the only thing stopping this market from completely melting. When we start losing these two, we'll start to see that capitulation and that fear start to come in, right? So critical levels, keep your eye on the weekly expected move. Any headlines that talk about extending the loss or the risk from this global situation. You also got a major lockdown in China. They don't screw around over there. They just shut down an entire district. And of course, with supply chain issues and shipping issues, lack of production and lack of manufacturing goes in with the whole inflation cost. And all of these companies that pulled out of Russia and are going to have to explain big losses when they report earnings. That even if the Fed was to come out with some reasonably buoyant news tomorrow, it's very unlikely that we're going to reclaim these levels quickly. Now, I'm not saying just run out and go short the market. You can build into your positions safely. Say, buy a put. And make sure your portfolios aren't contradicting each other. By the way, if you're already holding Apple calls or you're already holding Microsoft calls, then you wouldn't want to go in and start also taking puts in other things like IWM. Right? Don't go long and short against your portfolio. You're basically guaranteeing that one of your trades are going to lose. But say you're not in yet and you're looking at this situation, Apple, Microsoft, Google, all the names that have still not made significant downward moves, right? Sure, they're down, sure, they're off of their highs, but they're not beat down, right? Like Baba and JD and right, kind of go through the list. So the idea of going in and spending $1,000 on a put, that's a lot of risk to just buy a put and hope it all works out. We would not we would not do that, right? If you're bearish and you want to buy a put, be ready to sell a put in front of it. If we happen to rally back up hard off of these lows, say good news comes out on the war, or the war is over, or they've breached some critical level of negotiations and everybody thinks it's positive and we start getting that rip to the upside, don't sell your put as a loss and lock in those losses. Come in front of the one that you bought and sell one. Very simple math. Don't get stuck on the Greeks or any of that craziness. If you bought a put and you spent $1,000 for it, come up front a week, 2 weeks, 3 weeks, get enough time between those two so that they are moving at a different decay rate and sell a put for more money than the one that you bought. So if you spent 1,000 to buy a put, sell a put for 1,500, or just sell a put on the same strike. If you bought the 150, sell the 150. You may not perfectly protect your $1,000, right? You can see that these are $300 apart. They're $300 different, but you could protect yourself from a $600 loss, right? That you would in some way be able to hedge against that loss of the put. It would give you the opportunity to hold on to that put to make sure that we do actually rally back out and that we're not just getting a dead cat bounce or a slight rip to the upside before rolling back over again. It's trading like this that allows you to hang on to that long put. Now, if you're bullish or you want to get bullish or you want to stay bullish in this negative market, take the other side, buy a call. But again, that's $1,000 call. So if you buy the 150 for $1,000 and we continue to fall, be prepared to go in and sell a call against the one that you've got. This is why I haven't been doing a lot of verticals, right? Because if I've already built the vertical, then I can't sell a call against it. Or if I've already built a vertical put spread, then I can't sell a put against it, right? I take that ability away. Now, the vertical is a good way to go. It will limit your risk, but it's more of a binary trade. You're going to win, you're going to lose. It's two choices. If you just straight up buy the call or buy the put, you're no longer in a binary choice of winning and losing. You can do so much more than that. It's not the perfect situation. I'd certainly like to have more opportunities than what we've got right now, but it does allow you to participate in the market and not have to worry about being right all the time. Because it certainly doesn't look like we've got any reason to go long, but it's usually when everybody decides that we have no reason to go long and everybody goes short that the market starts to go up, right? Catches everybody off sides. We're going to wait for the Fed. We're going to be prepared to continue with this sideways market. Watch the institutional levels. No surprise, energy's down, emerging markets are down, minerals and mining is still down. We are starting to see a little bit of bump this morning in tech, healthcare, jets. So on these sector names, if we're down or up less than a half of a percent, then I really consider it a negligible value, right? I want to see things that have moved more than a half of a percent in the pre-market before we consider them up or down. Otherwise, they're just more flat than anything else. A massive gap down move in energy, and if you think about this, it fits the description of too far, too fast. I would not be surprised at all if we get a little bit of linear regression or some mean reversion, a bounce on that 20 period daily moving average, and a move to the upside. Deflection against the bottom of the previous day, March 14 low, would not be a surprise. So a little bit of a target on that upside move if we start to see it coming through. And it's not because we're bullish, it's just because we moved really fast, right? We moved really far, really fast in a small amount of time. Where's the pullback? It's as simple as that, right? Where's the pullback? Dead cat bounce. So energy should provide a pretty good catalyst for the day. If it stays bearish, if everybody just keeps piling it in and getting it more and more negative, that's fine. We can certainly play the game to the downside, but I'm going to be watching this for a flip back up and targeting yesterday's low as the first target on that. Right around that $74 for the most, right? For the highest target for me would be $74. That's XLE. You got an XOP as well, which is down even more. It broke that 20. Um, Very unlikely that we could get back above it, but the more times we crisscross through a moving average, the easier it is to go back through that moving average again. Silver and gold are both down, not too much of a surprise. Marijuana is only slightly down, and Bitcoin's down a half of a percent. This thing is a gappy, rangy bugger. Um, I know a couple of people have been trying to play this with the ETF, right? The BITO ETF. But in the short duration, I don't think you're going to have a lot of opportunity with this. Maybe longer term buy and hold would be better, right? The S&P legacy sectors, the top 11 sectors in the S&P, they really don't cover the kind of market that we live in today, right? In our world compared to say the last 50 years of the old school legacy sectors, which is why we've made our own sectors, just putting together the highest weighed names in the index for things like crypto, for an example, or the EV market. So when we're looking at the EV market, you can see we've still got some significant downward moves in XPEV, NIO also down now over to $13. We're running a wheel strategy in this thing and just getting our face ripped off, by the way. Um, but the good thing is once you own the stock and its volatility is high enough, those calls that you can sell can make up the difference. It's just going to take a while to make up as much difference as we have to make up bought into NIO at 17, and it's still going to the downside. So as long as that volatility is there, try to get the money made back in the short calls. It's going to take a while. If you can day trade, though, you can get it done a lot faster. So if your account is below PDT status, you're going to find you're going to be in that wheel strategy for a while. The chip names this morning are really strong. I would not expect this to continue, but you can see how we're clustered up. We're at a critical level, and it seems to be holding at least for this morning. Going to keep our eye on this for any kind of turnaround. And the pot stocks are a little bit of mix. So really, it's going to be energy and finance, just like it has been for the last couple of weeks. On a day-to-day basis, we continue to have really great setups in these two sectors, mainly because I'd rather go into the markets that have not already made, 2%, 3%, 4% moves on the day. That reversal in finance yesterday was just absolutely amazing. And these are cheap enough names, right, that you can kind of run it both ways, run it stocks and its options if you want to. You just have more choices, more ways to limit your risk. You see the China names getting really beat down, just like I mentioned yesterday before the Asian markets opened. I mean, it was a bloodbath. It was really strange to listen to Bloomberg just go on and on yesterday, last night, about how negative it was. And one of the commentators, I found it funny when he said it. He said, "Well, on Monday when the Asian market had opened, he said maybe it would be good if you just closed your eyes." He said, "But that was yesterday, and this is today. Rather than closing your eyes, maybe you should just close the market." That's that's how bad it was yesterday, right? That even the commentators on Bloomberg was like, "Yeah, just don't even open. Just stop it now before it gets any worse." And yet still, we're not seeing that bleed over into our market as bad as I would have expected we would, right? But there are some names, right? NIO, Baba, JD. So we are seeing that contagion, but it's very, very controlled. It's right there in the tech. Hasn't expanded too bad yet. You can see there's plenty of names on the weekly options list. These two watch lists are based on just nothing more than does the symbol have weekly options? And from that criteria alone, you can see that there are a lot of a lot of trade opportunities, even this morning, right? So there's plenty of choices out there, plenty of things on the move. Don't feel stuck like there's nothing to trade, but you know, try to avoid these things that are already up 9% or 6%, right? Unless you're going to run contrarian on these things. GameStop, for an example, up 5% this morning. Now we know that this thing can move massively. So I'm not saying it's going to turn around here and start to dump, but you're not going to continue to see a market move in a single direction nonstop. Always want to be looking for the pullback, the mean reversion, linear regression. There was someone that was asking questions the other day on the flex grid that had been shared, and I haven't talked about it much lately, so it's good to just come back in and point this out again because we continue to see new people coming into the bullish bears. This setup here, this little 9 chart setup, is a really great way to kind of see if you hone in on a sector, what names in that sector should you be focused on, right? We want the largest names in that list by weight. So if you're looking at something like the XLY, these would be the top names in the XLY, right? You see the XLY moving, kind of want to have an idea of what's in there moving the XLY around. We know that the two risk on sectors that really matter is finance and technology. So you go over to technology and kind of follow up with it. What's going on in tech? Who is in the tech space? Is any one of these names standing out and moving opposite of its peers? Is that name moving opposite because there's a catalyst, some news that's forcing that one particular market to deviate from its peers? Or is it beginning a new thing and the rest just haven't caught up yet? If you're trading one of these names, looking at the other names on the list can give you guidance on should you stick the trade? Is it starting to go against you? Should you still be in it? Maybe increase your position or decrease your position depending on what's going on around you, right? It's like we say constantly, it doesn't matter if you're trading Microsoft. Don't just stare at the Microsoft chart. Look around at what else is going on because Microsoft is not in a chasm all by itself. Microsoft is going to move with its peers. It's going to move with its sector. It's going to move with its index. Right? So bring up the sectors. Now, if you want these grids, I've shared them. Come over to the Bullish Bears Discord. Scroll down to Traders Resources, Custom Charts, or Custom Scripts. So we're in Custom Charts here. These are just regular watch lists. That's why it has the word watch list in there. And then here, where I share a picture of the grid, everything below this is where you're going to find chart links that bring up something like this, but for the sector that we're looking at. So XLF, there's the link. XLY, there's the link, right? And every one of these, when you import it, if it's not already named, name it something so that when you go in, you know exactly what it is that you're looking at, right? And just use the drop down menu. You got your list. So you can just bring it up and you immediately have a very clear idea of what names in that market are driving that sector. Now, when I built these, I had a much larger monitor than I do now. So I've been slowly going through and knocking out that lowest list because they're in here by market cap weight. So CMA on KRE is the biggest name in the list, and WAL is the smallest name on the list, right? And it just gets smaller and smaller as we go through here. So if we want to remove some names on the list, start with the lowest ones, work from right backwards to the left, eliminating names until you have a small enough grid that works for your chart. Well, each broker does its own thing. So these Thinkorswim links will only work on Thinkorswim. You can't import a Thinkorswim link on Interactive Brokers. You have to go to Interactive Brokers and build your own chart links. But you can figure out what's in a sector by going to Google, right? So if you're kind of new and you don't know what names make up a particular sector, think of Spiders, SPDRS. They have a website. And on that website, they have the 11 legacy S&P sectors. And in that legacy S&P sector list, they'll give you a breakdown by market weight of the names that make up that particular sector. So then you can go back to IB and you can make your own charts for the broker that you're using that has those names, right? So here's Communication Services, XLC. These are the names by weight that make up the XLC. So if we were to sort them by weight, then it's Facebook, Google, T-Mobile, Activision, and how many of those names can you look at on the monitor size that you have? Maybe 6, maybe 8, right? And just build your own grid out. So those links won't do you any good if you're not using Thinkorswim because they're Thinkorswim links. We know it's Thinkorswim links because it has HTTP TOS. I can't use them on Fidelity or Schwab or anywhere else, right? They'll only work on Thinkorswim. And I feel for all of you Canadians that are stuck using Interactive Brokers because that's a big POS. But if it's all that you have, then by goodness sakes, learn how to use it. I can't tell you how many traders that I know are absolutely completely handicapped because they can't figure out how to use that broker. That broker is really hard to use. It's complicated, it's confusing. I have it, so I know how complicated it is. But if it's all you've got, you got to make it work. Spend 3 weeks, 6 weeks, 9 weeks. It doesn't matter. Spend as long as you have to, day after day in, day out, doing nothing more than watching videos on how to use that damn thing. Because if you can't use your broker correctly, you're screwed. It won't matter if you think that that's a buy, it's a head and shoulders, there's where you're getting in. It won't matter on the technicals. It won't matter if you have a trade signal or a trade setup. If you can't figure out that broker, you're screwed. Right? So take your time, and it doesn't matter if it's Interactive Brokers, Fidelity, Schwab, whoever your broker is. If that's what you have, make it work. Spend as much time as you have to figure out how to use it. YouTube is a really, really great resource for that. Every single major broker out there has their own YouTube page. Some has more than one. Thinkorswim has 3 different Thinkorswim pages. Get on YouTube, figure out how to use your broker. If you're in the US, you have unlimited choices on the broker that you can use. So if your broker won't let you do something in the US, get a different broker, right? If you try to trade options on Thinkorswim and they tell you no because you answered the questions wrong, screw Thinkorswim. Go to a different broker, right? I don't trade very much on Thinkorswim, but I use Thinkorswim constantly. If they tell you no and you're trying to do something that you know is normal, get another broker. If you're not in the US, I feel for you because your choices are really limited. All right, let's wrap it up. Get our numbers for this morning. How bullish are we? How bearish are we? We're looking at the S&P 500. We want to filter this down. So pre-market change percent, use the filter, drop it down from 500 names to around 100 names. It's a little touchy. It's kind of hard to hit sometimes. 96, close enough. So this color scheme leaves a lot to be desired. We still need to sharpen the colors up. Just hit the multiplier here. All we're doing is taking it from a whole number to a tenth, right? We're adding a decimal. So the colors respond faster. The FANG names stand out: Facebook, Microsoft, Google, Apple, Nvidia. Apple's down slightly. As I mentioned yesterday, they're finally getting whacked on a global scale. We really want to keep our eye on this. Think of Apple right now as an indicator, not necessarily as a chart. And the chip names are looking good, but considering that, keeping that in our mind, Nvidia is not looking so hot in there. Neither is AMD or Intel. So we got a couple of names that are really beat down. Their connection with kind of the China sell-off. Flip this over from the S&P to the NASDAQ. We don't need a filter here because we've already got 100 names. Just need to adjust the color multiplier. And again, the FANG names stand out. And the two big down markets this morning, they're not down hard. They're just slightly down. They're weak. Tesla and Apple. These two are the market. Trust me when I tell you, if either one of these start to dive or spike, so will the market. It won't matter what the mega cap is. It won't matter if 90 names are going down. If Apple and Tesla start to rally, the market's going up. Right? So looking at advanced decline only gets us so far. We've got to keep our eye on the FANG names. How many names in the S&P are up at least 0.5%? 13. That's not bullish. How many are down at least 0.5%? 11. And that's not bearish, right? We're just sitting there in that happy medium, and it's very likely going to be this way until the Fed tomorrow, right? Until they come out with that decision. Sideways market is what we've been expecting all week. And we're going to see some movement. It's going to run around. We got a really wide range to deal with, but we're still not expecting to break critical levels and make drastic swings to the upside or the downside. It can happen. Oh, yeah, it can definitely happen. But without the catalyst and with Powell still waiting, then we're unlikely to see anything stick, right? It's likely to make a move and then revert back to the mean. It's been finance and energy. I would continue to focus on that, finance and energy. Right now, both of those can be broken down a lot more. When you say finance, it's very vague. What kind of finance? Insurance companies, credit cards, lending institutions, trade desks, regional banks. Same thing with energy. Just saying energy is really vague. Which energy should we be focused on? Green energy, oil production, drilling, exploration, transportation. So you really want to take it a little bit deeper and focus. The way I like to focus on it is, okay, I know the sector that's hot. I know the sector I want to keep an eye on. Which one of those names in that sector is liquid enough to trade? Does it have weekly options? That's a good start. If it doesn't have weeklies, it isn't even liquid enough to earn the right to have weeklies. I'm not trading that. If it does have weeklies, it still doesn't mean it's liquid, but at least it's a good start. It's a good thing to filter for right off the bat. Because it doesn't have weeklies, forget it. If you're trying to figure out, is it, quote, liquid enough? Just look at the bid ask spread. If the bid ask spread is really wide, it's not liquid enough. Open interest can be deceiving, volume can be deceiving. The bid ask really clarifies things nice and easy, right? The more it's traded, the more heavily it's traded, the more liquid it is, the tighter the bid ask spread. And for a perfect example of that, you can measure everything against SPY. SPY is the most liquid product that exists in the marketplace. For a day trade, healthcare doesn't fit my needs. It doesn't have a great enough beta. So I want to see things that can make an exaggerated move on a day-to-day basis. And for me, healthcare just doesn't have the beta to do that, right? I'm talking about being able to trade an option far enough to actually get, say, 30 to 40 cents on the dollar. You take a market like Johnson and Johnson, how far can Johnson and Johnson move on a day-to-day basis, right? And sure, there are times where you get some exaggerated moves. And if I was looking for some swing trades, healthcare would most certainly fit the bill. But day trading and options, their prices are really high. They're very often an illiquid options market. And then how far can it go? So, looking at it from that point of view, a $30 financial stock, super liquid options, fits me better than a $172 Johnson and Johnson stock with reasonably decent options or illiquid options and a really wide bid ask spread. Plus, if you take a look at how financials made big sweeping moves, and we're sitting here looking at a day-to-day healthcare where everything was just sideways, we had some good moves. Don't get me wrong, right? There's always opportunities, but it has been, and at least for me, for the next 2 days, will continue to be energy and banks. They're cheap, they're liquid, and they move. Not much yesterday, right? But enough just because their options are cheap enough. The really great thing about trading is if you can find a way to do it that suits you, then you're not doing it wrong, right? Do healthcare, do utilities, industrials, whatever you like. If you can make money on it, you're not doing it wrong. That's it, guys. It's all for me. I'm going to get out of here. Be careful, be safe. Have a good morning. Keep your eye on your Market Watch tab. Get these econs out of the way. They're pricing in right now, right? The 830s, but we still got Red Book. And then you've got the 11 o'clock bill announcement. Don't sleep on that bill announcement. I'm telling you, those additional auctions that come in and these announcements at 11, 11:30, 1 o'clock, when it's those days and we have those, they can completely reshape our market. Other than that, I'll see y'all tomorrow.